Peak oil demand. IEA says demand growth slows to a crawl after 2025, stays bullish on U.S. shale production, and warns on climate change. Sour milk. Dean Foods declares Chapter 11 plagued by weaker sales, tighter margins, and ballooning debt. And making money with ag tech. I sit down with Dwight Anderson of Osprey Management to find out how he makes money helping farmers. I'm Alix Steele. Welcome to Bloomberg Commodities Edge. 30 minutes focus on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. We want to kick it off with Spot On, our analyst and investor take on the big story. Joining me from London is Julian Lee, Bloomberg's oil strategist, and our spotlight is on the International Energy Agency versus U.S. shale players and their outlook on production. We had the long-term report from the IEA. One part of it was peak oil demand. Julian, what did you learn?
Well, the IEA has this scenario of stated policies. This is what governments and companies say they are going to do in future years. And under that scenario, they see oil demand growth slowing to virtually zero after about 2030. It's still growing very slowly, but most of that growth they see coming from biofuels, not from crude oil pumped out of the ground. That's the demand side. And the supply side was also quite interesting because unlike U.S. E&Ps, they were actually quite bullish on U.S. shale production. Yeah, I mean, that came as a bit of a surprise to a lot of people who are starting to see a slowdown in shale in the U.S. But I wrote a column a few weeks ago now saying that although this second shale boom seems to be coming to an end, I'm expecting a third boom to follow it, driven not so much by the smaller companies that have driven the first two, but by the majors who are moving much more aggressively into the shale patch. That means I think that growth will be slower, but it may be more robust in the sense that it will be able to weather a period of lower prices if lower prices come. And that's the other interesting thing from the IEA report. They see prices rising out to 2040, even with this dramatic slowdown in demand growth. All right, Julian, thank you so much. I just want to see the revisions when they come. Bloomberg's Julian Lee. And now into that, you have Saudi Aramco kind of stuck in the middle.
I think Saudi Aramco is a fundamental different animal. You know, it's a huge oil and gas company, huge resource. It's one country. It's a clear policy. So it's very difficult, I think, to try to find what is the valuation that the market will give to Saudi Aramco from what is Total or Shell or Exxon.
And joining me now is Leo Mariani from KeyBank. So this really sets up the Saudi Aramco IPO and the fundamental backdrop. What is it listing into?
Yeah, I think right now when you look at the energy equity markets, I think sentiment is at a 2 or 3 decade low. We have seen continued underperformance from energy equities across the board. You've obviously had very strong broad market performance this year. WTI oil prices are up roughly 25%. And generally speaking, the major oil companies are flat. And the smaller ones are down, 20% plus in many cases. So very poor investor sentiment right now for energy equities. Now, I guess then the question becomes, as you wind up having Saudi Aramco trading at the same time where OPEC's going to be meeting, does this sort of move OPEC in the direction of more cuts, more supportive of prices, et cetera? Well, I think what you're going to have to see is Saudi Arabia do their best job from a diplomatic perspective to really lobby a lot of the other OPEC members, as well as some of the large non-OPECs like Russia, to really come out with some positive messaging on December 5th and 6th when they meet in Vienna. I don't expect to see deeper cuts necessarily at that meeting, but I think they're going to extend the cuts further on into 2020. And I think really try to portray an image of solidarity in making sure that people stick to their cuts. So what do you then foresee for U.S. shale production, say, versus OPEC and the Saudis? I mean, are you more on the IEA side, where you're bullish on U.S. shale production, or are you more on the conservative side? I think I'm probably somewhere in between here, Alix. So I certainly do see a deceleration of U.S. oil production growth in 2020. In 2019, we're probably going to see just over 1.2 million barrels a day of growth. I think that number moves to somewhere between 800 and 900,000 barrels a day. in 2020. So clearly, growth will slow over the next couple years. Now, part of that is the law of large numbers. As we get larger, it becomes harder to grow. But we're also seeing some of the better inventory in the shale play start to become more and more exhausted over time.
On the more bearish side, ironically, is a U.S. shale CEO. So I spoke to Scott Sheffield earlier in the week. He's the CEO of Pioneer Natural Resources. Here's what he had to say about his prediction.
They're way too optimistic on U.S. oil shale. So the numbers have been driven down significantly. They're saying it'll supply 85% of the growth in the world's growth in oil over the next, between now and 2030. That's the next 10 years. I think it'll be more like about 35%.
What if he's right, Leo?
Well, I think that clearly would have, broad-reaching implications for oil prices. To the extent we do see even a more broader slowdown in U.S. shale over the next several years, then clearly I think you'll see oil prices move in the upward direction. I continue to believe that as you look out into, say, 2023, 2024, and beyond, we will see more of a pronounced slowdown in U.S. shale. However, I think in the short term, you're still looking at pretty rapid growth, but certainly when you get into the out years, a lot of the key plays that have driven the revolution, like the Eagle Ford and the Bakken, will have virtually exhausted most of their inventory. So shale growth rates will clearly slow down.
Yeah, Leo, and there was another note that caught my eye this week. It actually came from Bernstein, and they were talking about peak oil growth, but they didn't really look at it in the U.S. at first. They actually said that deep water will actually peak in 2020, and then shale is going to peak a few years later, and then oil sands is in question because of sustainability and CO2 emissions, which leads to the whole we're going to have higher prices, which is something that the IEA highlighted in their report. What do you make of that kind of call?
Well, I think from a deep water oil perspective, you have a lot of growth over the next 6 to 12 months, driven by the startup of a very large field in Norway last month. You also have production starting to come on in December for the first time in Guyana, and Brazil will continue to grow throughout 2020 as they bring on some deep water fields. So I do think you'll see continued growth into 21, but I generally agree with the premise that there is a lack of large deep water oil fields that are going to be coming online as you work your way into 21 and 2022, really due to lack of investment after oil prices crashed in mid-2014. So I do think you are going to see a significant slowdown once you get past 2020.
Leo, I really appreciate it. Thank you very much for joining me, Leo Mariani of KeyBank Capital Markets. And here was another interesting tidbit from the report. So in the IEA's report, it showed the pickup in demand growth for solar and wind, but bad news is it wasn't enough to curb greenhouse gas pollution, which keeps rising. Their outlook was not good. President Trump, though, this week is optimistic, kind of.
I consider myself to be in many ways an environmentalist. To me, it's clean air and crystal clean, clear water. I'm very much into climate, but I want the cleanest air on the planet, and I have to have cleaner water. Now, see, it's been a year, so now they think we have 11 years to live. I don't know, folks. I think these people have gone totally loco.
I'm Alix Steele. This is Bloomberg Commodities Edge. A time now for the data dig, where we delve deep into the market trends. First up, you got the oil inventory numbers. So overall, you saw a surprise build of about 2.2 million barrels, and U.S. production hit a record. I do want to point out the Cushing inventories within PADD 2 fell last week. That's after the Keystone Pipeline outage actually crimped the flow from Canada to the U.S. And baby, it was seriously cold outside. So power prices popped 1,700% on Wednesday morning for a major hub that stretches from New Jersey to Illinois, as extremely low temperatures rivaled the chill of the Blue Norther in 1911. And finally, even a trade deal might not really help cotton. So prices getting crushed. You got farmers sitting on high stockpiles, or the blue bars right there. Competition's also rising from Brazil. Paints a grim picture for farmers, even if China has to restockpile some of its cotton as their stocks wind up coming down. All right, now we want to get into the ring, where one milk company fights for survival. Dean Foods, America's largest producer, filed for bankruptcy as consumers have been moving towards alternative drinks like almond and soy. I'm joined now by Lydia Mulvaney from Chicago. Lydia, they've been trying to find a buyer for this for a while. What was the catalyst? What happened?
One of the things that led the company to where it's at right now is that, they had a huge amount of debt. The culprit was probably this underfunded pension fund that did not make them attractive to buyers outside of a bankruptcy.
Lydia, that net leverage is now about 631 times compared to normalized, which is like 2.7 times. Does someone actually want to come in and buy this or buy parts of it? Are there reasons why it's still attractive?
Yeah, well, right now, the company is in talks with Dairy Farmers of America. Dairy Farmers of America is, Dean Foods is their biggest buyer. So they already have, a very strong relationship. So they're in talks, but, there are a lot of hurdles ahead. There's a group of bondholders out there that are really against the sale. They want to see a more standalone restructuring, and they think that there could be, some antitrust problems. They're both really huge giants in the dairy industry. So, that'll be worked out, through this bankruptcy process, and, which could take up to a year. I'll also say that, just because they're in talks doesn't mean that they get to buy Dean Foods if they come to a deal. There might be other bidders. But, basically, the bondholders, they just don't want to see a fire sale. They want to get the maximum value for the company.
So a part of that is that they do have some good assets. I mean, ice cream sales, for example, were actually up. Obviously, the bulk of their revenue, like 67%, still comes from milk. But what part of their businesses might actually be of higher value?
As you said, they might have some ice cream plants that might be attractive. And there are other companies operating in parts of the country where Dean is all over the country. So there could be some milk plants that are useful to other players in the industry.
And last question, is there any hope for milk sales? I mean, this is a structural shift, a structural decline. Is there any hope?
So I think the dairy industry is trying to figure out how to play catch up a little bit. The market has really changed over the last decades, and I think the dairy industry is really trying to figure that out. Some of the things that they're doing is really trying to come out with some new products that emphasize nutrition. They'll be really high in protein, a higher protein milk with less sugar. Things like lactose-free are actually growing quite a bit. And then there's been some success stories like Fairlife, which went from zero to, hundreds and hundreds of millions in sales in just 5 years. And that's like a high protein drink.
Lydia, thank you so much.
There are some ways forward.
I really appreciate it.
Thank you.
Bloomberg's Lydia Mulvaney. And time now for our note of the week. And it comes to us from billionaire activist Carl Icahn. He minces no words to Occidental CEO Vicky Holub, saying, quote, in the same way that WeWork, Enron, and WorldCom are each one-word descriptions for massive corporate disaster, I believe Oxy has become a metaphor for an undisciplined management team who, with a do-nothing board, gambles a stable company on a high-risk, highly levered bet. Ouch. And Icahn says Holub's asset sale plan, which she thinks could be on the upper end of its range, could only be achieved with a fire sale. And coming up on this program, Dwight Anderson, founder of Osprey Management, talks about how ag tech could help the struggling farm industry. Next on Bloomberg Commodities Edge. I'm Alix Steele. This is Bloomberg Commodities Edge. Time now for Bnef Brief, which gives in-depth analysis on clean energy, advanced transport, commodities, and emerging technologies. The IEA's latest report says in order to meet goals scientists say is necessary to protect the environment, the sustainable development scenario there on the chart, the world needs a lot more wind and solar. Joining me now is Ethan Zindler from Bloomberg BNEF. I want to focus on solar. So how are solar companies positioning themselves for potential demand?
Well, we're seeing a lot of changes, but certainly companies are looking along the value chain to try and figure out where's the smartest place to play, and whether it's on the manufacturing side or closer to the customer in terms of doing installations. There's a good deal of reshuffling going on in the industry right now.
You set me up. SunPower, that was news of the week. So basically it's keeping its installment business, it's spinning off its manufacturing business to partner with a Chinese company. What'd they do?
Yeah, so it's an interesting watershed. I mean, for those of us who've been around this industry a long time, like I have, we can remember 15 years ago when SunPower was started and how much they've emphasized the quality of the equipment that they've made over the years. But over time, they have focused more on installations and looking further downstream. So this is somewhat of a natural move. It's also reflective of overall the fact that solar manufacturing has become incredibly commoditized. And the biggest players, often Chinese players, are the ones who can produce often at lowest cost.
So how does that wind up shaking out? Are we going to see like most of the manufacturing now in solar come from China? Without it, we don't get the scale that we need?
I mean, most of it already are from companies that are headquartered in China. In fact, many of them have their manufacturing operations in Southeast Asia, in part because it's cheaper, but also in part to deal with some of the tariffs that have been placed on U.S. imports of solar equipment.
What are other companies doing in this space?
So see, it's interesting. There's different companies doing different things. First Solar is another company that was vertically integrated. They provide equipment for large-scale, utility-scale projects. They have a slightly different technology than SunPower does in terms of the modules. They've de-emphasized now on doing engineering work around building projects and are focusing very much more on upstream. They're building a giant new manufacturing facility in Ohio and emphasizing the fact that they actually make very large-scale solar modules.
Great stuff. Really interesting development. Ethan Zindler of Bloomberg NEF, thank you very much. We want to turn now to Commodity in Chief, where we focus on one executive in the commodity world. And today it's Dwight Anderson from Osprey. First, we want to take a closer look at the issues facing some farmers.
Experts say the global population will reach 10 billion by 2050, and that means farmers need to produce 50% more food. The problem? Fertilizer's almost maxed out, and available water is running dry. One potential solution is genetic engineering. Take breeding, for example. If you can map crop DNA, you can probably cut down on the number of breeding cycles. Genetic engineering can also help a crop develop more resiliency. And any changes can apply to all crops, like corn and soybeans, but also the orphan crops, like millet, barley, and peas. Big companies and small are getting creative. Bayer, for example, is selling genes that help corn grow in high heat to states up north as the temperature changes. All of this requires technology. Enter AgTech, the hot new investment ticket. $6.7 billion was poured into the sector in the last 5 years, and venture capital deals are increasing. There were 28 globally in the first 10 months of 2018 for companies making sensors and smart farm equipment, and 19 for imagery companies. And hedge funds are also getting in on the action.
I recently caught up with Dwight, and I asked him what his definition of AgTech is.
Any innovation to help improve the economics and productivity of farmer food. For ourselves, we add in the incremental element that it should also be environmentally beneficial. And we don't actually get into the distribution or the end food element. We're purely focused on farming. So we're focused on how do you improve or keep the economics at a minimum for the farmer the same, while also improving the environmental impact.
What do you like with that?
One of the companies which we're structurally involved is a public company that we took control of called Marone Bio, which is involved in biologics, which are the products that you can put on organic farms and still have them called organic. And then in addition to that, some private companies. There's a company in Vancouver called Terramera that has a tremendous game plan and product to really be able to lower the intensity of use of synthetic chemicals. So by combining its product with the existing chemicals, you can lower use by 80 or 90%.
What about bees? This is one of my favorite ones.
It's an issue that's commonly talked about in terms of the issues in terms of just the death of the different hives in the colonies. But what we found when we were looking into that problem and its effect also on the economics for farmers, especially sort of tree nuts and berries, is that there had been no real work done in terms of innovation on how does pollination improve productivity and how could you improve that. And one of our partners, named Alan Boyce, who's on the board of Adecco Agro, came to us with a company called BeeFlow that had been started up by an entrepreneur from Argentina called Matias Viel. And what it does is it really works on coming up with an improvement to the sort of activity-focused food for bees to improve their activity level and pollination, and is showing really significant results in terms of how much we improve not just the yield, but the quality of the fruit or nuts.
How do you see sort of the chicken and the egg there? Like, do you need companies that are already in good standing, or a farmer that has enough money that they can go and spend on this efficiency, or do they need you to help them fund it because it's really hard to be a farmer? Like, what's the circle?
Well, because we're worried about the overall profitability levels in general of agriculture and farming, we're looking for products that allows the farmer to spend less on inputs. So as opposed to something like a harvester, where Deere is asking you to spend $500,000 to $1 million to get an improvement there, and so even if it gives you productivity, you have to write a huge check up front. What we're trying to do is give you products that allow you to spend the same or less and get cost benefit. So even if you're somewhat cash strapped, you can actually use our products.
How do you find these opportunities?
The ag generally just is our guys are out there looking all the time, attending every conference, but we've had tremendous success with our partners, the farming companies we started or have partnered with. Generally, people in farming say, hey, I tried this, I looked at this, and it really looked like it worked well. I'm excited by it. You guys should look at it. And so the majority, really, of our investments have come from our network, and also some of our partners who've joined the firm, like the former CFO of Monsanto, people from Dow Agro, have got a great network in the ag chem side, and they've brought us deals as well, too.
How much of your bet on ag tech like this and sort of really putting a lot of resources behind it, hiring people behind it, has to do with climate change versus just it was an opportunity set to get more efficient in an industry that hasn't been able to, or a combination?
It's focused much more on doing more with less environmental benefit and economic benefit. To be honest, climate change is something that we worry about because it's going to so change if it happens suddenly, how stuff is grown, where it's grown, the conditions, the water, that we're not 100% positive how that's going to play into the inputs and in terms of our customer base. And so it's a risk to us due to its unknown impact rather than being a catalyst.
That was my interview with Dwight Anderson of Osprey. All right, cruising the melting Arctic Ocean. So this cruise ship, Crystal Serenity, set sail from Alaska with 1,700 passengers and crew, circled around the peninsula and through the Bering Strait before heading east. For centuries now, explorers tried to find a sea route between Europe and Asia, and they failed big time. Some stranded sailors even had to eat their boots and each other. But this vacation does not include cannibalism, but it does come with an expiration date. NOAA says the region's heating twice as fast as the rest of the globe. Arctic tourism is now known as last chance tourism. Check out these landscapes and species before they're gone for good. And here's what's on my commodity radar. So Sunday, the day we're going to get Saudi Aramco pricing and the roadshow kicks off. Tuesday, you get Conoco's analyst meeting. Analysts very optimistic. And Wednesday, Bloomberg New Economic Forum starts in Beijing. That does it for Bloomberg Commodities Edge. Tune in every week at 1 p.m. on Thursday. This is Bloomberg.